All right, welcome to TalkTickers. Today we're diving into Nextracker.
Yeah, we've got their latest earnings call Q4 and full fiscal year 25 results, plus their look ahead.
And spoiler alert, it sounds like things are going pretty well for them. Overwhelmingly positive is the vibe I got.
Definitely. I mean, the numbers really speak for themselves. Strong growth, solid execution, very optimistic tone.
Okay, so let's start with the headline numbers for fiscal 25. They wrapped up the year with some records, right?
They did. Full year revenue, first off, hit about $3 billion.
$3 billion, wow.
Which is, an 18% jump compared to fiscal 24.
Okay, 18%. And profitability, that looked even stronger.
It really did. Full year adjusted EBITDA, $775 million. That's up 49% year over year, almost 50%.
49%, yeah.
Yeah.
And adjusted EPS.
Also a record, $4.22 per share, which is up 38% from last year. So really significant growth on the bottom line too.
Those are serious figures. And it wasn't just a good year overall. Q4 itself was strong.
Q4 was also a record breaker. Revenue was $924 million, up 26% year over year for the quarter.
26% just in the quarter.
Yeah. And adjusted EBITDA for Q4 hit $242 million. That's up 52% compared to Q4 last year.
52%. Okay. Now, something that really jumped out at me was the backlog.
Oh, yeah. The backlog growth is huge. It's now significantly over $4.5 billion.
$4.5 billion. Just think about where they were, February 2023 at the IPO?
Exactly. Back then, it was $2.1 billion, so it's more than doubled in, just over a year. Incredible visibility that gives them.
And all this translates into cash, presumably.
Right. They flagged robust cash flow generation. Let's maybe dig into some of those numbers a bit more.
Yeah, let's do that. So revenue mix, still mostly U.S.
Yeah, pretty consistent. For the full year, it was 69% U.S., 31% rest of world. So international is still a solid chunk.
Okay. And profitability metrics, adjusted gross profit over $1 billion for the year.
Just over $1 billion, yeah. The Q4 adjusted gross margin came in at 33.4%.
Which they noted was down slightly from Q3.
Right, but they did explain that. Said it was because of some one-off benefits in Q3, so maybe not something to worry about structurally.
Okay, so probably still strong underlying margins. Full year adjusted EBITDA margin was around 26%?
Around 26%, yeah. And that Q4 adjusted EPS number was $1.29, up 34% year over year.
Solid. Now, cash flow, you said it was robust. Give us the details.
Okay, so adjusted free cash flow for the full year was $622 million.
$622 million.
Yeah, and $227 million of that came just in Q4. Operating cash flow in Q4 was $237 million, and CapEx was pretty light, only $10 million in the quarter.
So generating a lot of cash, and the balance sheet reflects that.
Absolutely.
Yeah.
They ended the year with $766 million in cash on hand, and importantly, zero debt.
Zero debt. That's impressive.
Yeah, gives them about $1.7 billion in total liquidity. They did use some cash in FY25, retired $150 million in debt before getting to zero, and spent about $152 million on acquisitions.
Having no debt and that much cash is, it's a great position to be in. Lots of flexibility.
It really is. And that ties into their strategic positioning, which was another big theme on the call. They kept emphasizing their market leadership.
9 years running, right? Global and U.S. leader.
9 consecutive years. And they actually grew their global share again in 2024. Mm-hmm. Top share in the U.S., Europe, Latin America, Australia, strong pretty much everywhere.
And they talked about this flight to quality. What's the thinking there?
Yeah, it sounds like, as solar projects get bigger and more complex, maybe with some lingering supply chain worries, the big developers are really prioritizing partners they can trust.
Partners with scale, a track record.
Exactly. Some with a solid balance sheet, proven products, reliable delivery. Nextracker believes their leadership position, that huge backlog with top-tier customers, and their very flexible supply chain, remember, over 90 manufacturing sites across 19 countries, makes them the go-to choice in this environment.
Makes sense. And innovation seems central, too. Tripled R&D.
Tripled it in recent years, yeah. And they mentioned a record patent count, 1,220 total patents, with over 600 issued.
And that R&D is leading to products people are actually buying.
Clearly. They highlighted a few. The Hail Pro series, designed for hail protection, has sold over 9 gigawatts already.
9 gigawatts, wow.
Their XTR tracker, which handles uneven terrain, that's sold 17 gigawatts. And the True Capture software for boosting energy yield is seeing gains too.
And all this innovation feeds into their bigger strategy, right? Moving beyond just trackers.
Exactly. They're really pushing this transition from being a pure play tracker company to becoming a solar power technology platform supplier.
Okay, platform supplier. What does that mean in practice? Acquisitions.
Yeah, acquisitions are a key part. They bought 2 specialty foundation companies last summer, and more recently they announced the acquisition of Bentech Corporation.
Bentech, that's the EBOS company, right? Can you quickly explain EBOS for us?
Sure. EBOS is electrical balance of system. So think about all the wiring, the harnesses, connectors, cable management, everything needed to connect the panels on the tracker structure itself, getting the power to the inverters.
Got it. So it physically attaches to the tracker.
Precisely, which is why the acquisition makes so much sense strategically.
Right, because now they can offer an integrated package, tracker and the electrical bits that go on it.
Exactly. The idea is to simplify things for the customer, offer a single source, plus they can potentially co-optimize the design of the tracker and the EBOS, maybe make installation faster or improve reliability.
And leverage their own global footprint to sell more Bentech stuff.
Right. Bentech is already like a top 3 or 4 player in the U.S. EBOS market. They have manufacturing, a 15-year track record focused on quality. Apparently, they test 100% of their harnesses, which is a big deal.
Quality and reliability are key for these big projects.
Definitely. And they mentioned this helps build out their U.S. supply chain for these components, too. They see real synergy here. The products touch. Designing them together helps, aligns the sales process, offers combined branding and warranty.
Interesting. And they hinted at other deals, too.
Yeah, they mentioned completing other unannounced acquisitions as part of this platform strategy. Said they'll share details in the coming months.
So this platform expansion is serious. What's the long-term goal?
It's ambitious. They're aiming for about 1/3, 33% of their total revenue to come from these non-tracker solutions within 5 years.
A third of the business. Okay.
Yeah, they're planning an analyst day this fall to lay out the whole strategy in more detail.
Okay, so looking ahead, what's the guidance for fiscal year 2026?
The outlook. They gave ranges.
Yeah.
Revenue between $3.2 billion and $3.4 billion.
Okay, so potentially up from FY25's $3 billion?
Potentially, yeah. Adjusted EBITDA between $700 million and $775 million.
Okay, the top end of that EBITDA range matches the FY25 actual, but the bottom end is lower. Why the potential dip?
Good question. It's about investment. They're planning to accelerate investments in FY26.
To build out this platform strategy.
Exactly. They expect operating expenses, OPEX, to increase by about 100 basis points as a percentage of revenue.
So 1 percentage point higher OPEX relative to sales.
Right. To integrate Bentech, build out other adjacent solutions, boost the go-to-market efforts. And capital expenditures, CapEx, are also set to rise quite a bit to around $100 million, investing in manufacturing R&D facilities.
Got it. So investing now for future growth, which impacts near-term profitability guidance, but it's strategic.
That's the message. And despite those investments, they still expect to generate significant cash.
How much?
They're projecting over $450 million in adjusted free cash flow for FY26.
Still very healthy.
Yeah. They also mentioned about $110 million in cash payments expected in FY26 related to acquisitions already done, not counting any new M&A.
And even with that, they expect cash balances to grow.
They expect to end FY26 with over $1 billion in cash. Again, assuming no new M&A or big capital allocation shifts.
Over $1 billion in cash and no debt. Wow. What about margins for FY26?
They guided for structural gross margins in the low 30s.
Yeah.
Mentioned things like geographic mix, potential tariff impacts, and the cost of scaling up these new acquisitions could influence that.
So how did they frame the overall guidance?
Confident?
Cautious.
I'd say prudently confident. They acknowledged macroeconomic uncertainty, but pointed to that huge backlog, the flight to quality trend, and their team's ability as a reason for high confidence in hitting those numbers.
Okay. What did they say about the current market environment? U.S. still strong?
Very strong, yeah. Seeing top developers pushing projects forward, securing pipelines, using safe harbor rules, focusing on domestic supply. Things are moving.
And internationally?
Also strong. Signed deals in 17 different countries just in Q4. Growing pipeline internationally. Europe saw record volume. Spain was a highlight. Latin America solid, led by Brazil. Gains elsewhere, too. Australia, India, Middle East, South Africa.
And that international share held steady.
Yep, still 31% of revenue for the full year.
Okay, let's talk policy. There was discussion about a House tax bill draft.
Right. They touched on it, mentioned some good things in the draft like the 45X manufacturing credits and the timing around the 30% investment tax credits, 48E.
But also some concerns.
Yeah, areas they see needing improvement. Things like how tax credits can be transferred, potential issues if rules shift from start of construction to placed in service for qualifying, and some rules around foreign content.
Are they engaging on this?
Oh, yeah. Said they're actively talking to folks in Washington, working with trade groups. They really leaned into their U.S. manufacturing story, 9 public factory openings, over 25 U.S. manufacturing partners, making the case for domestic production.
And tying solar to energy independence.
Right. Highlighting that solar was over 80% of new grid capacity added last year, making the argument that it's key for U.S. energy dominance.
So cautious optimism on policy, but it's a long road.
That's the sense. Importantly, they said this specific draft, even if passed as is, likely has minimal impact on their results for the next couple of years because so many projects are already grandfathered under current rules.
So the impact is more medium term, like 3-4 years out.
Exactly, on the future book of business. And they clarified their FY26 outlook already incorporates their assumptions about tariffs.
Got it. And they finished by connecting all this to the bigger picture, right? Electricity demand.
Yeah, the macro trends. Structurally increasing global demand for power driven by AI data centers, EVs, building electrification.
The numbers there are kind of staggering.
They are. They talked about needing terawatts of new capacity globally in just the next 5 years. A terawatt is 1,000 gigawatts.
And the entire U.S. utility solar fleet is maybe, what, 150, 200 gigawatts now?
Exactly. So we need multiples of the current installed base and quickly. This huge demand really underpins their market opportunity and their whole platform expansion strategy.
Okay, that sets the stage nicely. Now let's shift gears for our not financial advices segment.
The disclaimer part.
The very, very important disclaimer part. What we're about to discuss is absolutely not financial advice. It is purely hypothetical brainstorming for informational and, frankly, entertainment purposes only.
Seriously, do not base any investment decisions on this. Investing carries significant risk. You could lose money.
Please consult with a qualified financial advisor. Okay, disclaimer done. So imagine we're pitching a bold, maybe slightly outrageous, but perhaps plausible trade idea based purely on this Nextracker call.
Okay, lay it on us.
How about this? A speculative pair trade. Go long Nextracker and short, a traditional legacy power generation company. Maybe one heavily reliant on coal or older fossil fuel assets.
Interesting. Walk us through the thesis. Why that pair?
Okay, the core idea is playing the acceleration. That explosion in electricity demand from AI, EVs, et cetera, isn't just happening. It requires rapid grid build-out. And the fastest, most economical way to add utility scale generation right now, it's largely solar.
And Nextracker is the leader in enabling that solar build-out.
Exactly. Dominant market share, huge backlog. They're expanding their offering with EBOS and other things, basically increasing their dollar capture per project. They're moving up the value chain. And crucially, they have that fortress balance sheet, tons of cash, no debt. That gives them options for more M&A, maybe even buybacks or dividends eventually.
So the long Nextracker leg is betting on them winning big in the solar build-out. Why short the legacy generator?
That's the hedge, but also the other side of the transition bet. Those legacy companies, particularly those with older, less flexible fossil fuel fleets, might face slower growth compared to the renewable boom. They could face regulatory headwinds, maybe even stranded asset risk down the line as the grid decarbonizes and modernizes.
So the short is a hedge against general market downturns, but also expresses a view on the direction of the energy transition itself.
Precisely. You're betting that the enablers and builders of the new energy system, like Nextracker, will outperform the incumbents tied to the old system, especially given the accelerating demand picture.
It's definitely a provocative thesis tied directly to the trends discussed on the call. Of course, massive risks involved, right?
Oh, absolutely. Policy is a huge wildcard. Changes could help or hurt either side unexpectedly. Execution risk for Nextracker's strategy. Can they integrate acquisitions well? Can they hit that 1/3 non-tracker target? The timing of the transition is uncertain. And, specific company risks for whatever legacy generator you choose to short.
Huge risks. Definitely not one for the faint of heart, even hypothetically.
Not at all. But it's an interesting thought experiment based on the dynamics they laid out. Strictly hypothetical, of course.
Understood. So, just to wrap up our deep dive on Nextracker's call, a really strong fiscal 2025. Record results everywhere, revenue, profit, cash.
Sure.
And that backlog growth provides exceptional visibility.
Yeah, the balance sheet looks fantastic, and they're clearly executing a deliberate strategy to become more than just a tracker company, using M&A like Bentech to build out that solar power platform.
The FY26 outlook reflects confidence, but also acknowledges the investments needed to fuel that platform growth. Still expecting strong free cash flow generation, though.
Seems like the focus is squarely on long-term execution and capitalizing on this massive global need for more electricity, positioning themselves as a key technology provider for the solar build-out.
And one final time. This discussion contained forward-looking statements. Investing involves risk. This was not a recommendation to buy or sell anything. Always do your own research and consult a professional.
Absolutely. Thanks for tuning in to this deep dive.